Hello everyone and welcome to this bobsguide webinar. I am Neil Ainger, the Editor-in-Chief of bobsguide. The subject for today's webinar is regulatory reporting factories. What are they and how can they help you? We'll be examining what a regulatory reporting factory is, how it operates, the technology and automation processes behind it, and how it can potentially help CFOs and risk and reporting compliance officers at banks and FIs comply with all necessary regulations. With the raft of new post-crash regulations now hitting the sector, such as Basel III, Dodd-Frank, EMIR in Europe, the US Fed's CCAR rules, and so forth, not to mention all the usual sanctions and AML screening duties and OFAC's compliance procedures, it is essential that firms get on top of their regulatory reporting duties or face fines. Companies must understand and be able to track their higher liquidity and capital requirements in this new normal regulatory environment, which also demands less leverage on balance sheets, and companies have to be prepared to report to domestic or regional regulators quickly, sometimes in real time or even intraday. We are very happy to be running this webinar with our sponsors HCL, and we will be hearing shortly from David Paris, a global solutions partner at HCL Technologies, who is in charge of risk, compliance and data, and will be running the presentation today. The wide-ranging discussion will touch on the mechanics of a regulatory reporting factory, explain the concept, uptake, and share any examples while touching on some of the raft of regulations that we've mentioned there. And it will also provide an opportunity for interactive questions at the end of the presentation. Before we go any further, however, there are a few housekeeping points that I'd like to highlight. If you have a question to ask our speakers at the end, please go to the box on the bottom right-hand side of your screen and simply type it in. I'll use it at the end of the hour-long webinar today, time permitting, during the Q&A session at the end. The entire webinar will also be recorded, so if you miss anything or think a colleague would be interested to listen in later on, you will be sent a link to the recording. So without further ado, I'll hand over to our speaker today, David. Over to you, David.
Neil, and welcome. Thank you, Neil, and welcome to everybody for joining us today. As Neil noted, I'm David Paris. I'm Global Solutions Partner for Risk Compliance and Data Management in the financial services vertical globally for HCL. First of all, a little bit about HCL. We are a $6 billion turnover per annum conglomerate. That's U.S. dollar basis. We are one of the first and certainly one of the largest Indian-based so-called pure play type of IT services organizations. I previously was actually a client in one of my prior roles earlier in my career. I have 30 years of experience in financial services industry, split approximately equally between working for banks, broker-dealer organizations, balance sheet banks, and what have you, having originally been trained as a credit officer at Wells Fargo. And about 10 years ago, in a role for Deutsche Bank, was a client at HCL, have also had extensive risk management and compliance reporting responsibilities in multiple different organizations. Prior to coming to HCL, worked at IBM for 5 years. So we have a large number of clients that, especially over the last 3 to 4 years, increasingly have asked us to work with them on implementing new regulatory reporting solutions, and that's one of the genesis of the direction of this business that we're going to be talking about today, the so-called reg reporting factory approach. What I'll do is move on to describe a bit on the slide that's in front of you now, with number 3 at the bottom, a bit about what our area covers in HCL. There are 4 key propositions that we have. The one that we're going to be focused on today is the one at the top, reporting, analytics, and control, where the focus is to create, as described, a factory scale basis reporting of fixed content and certain capabilities, with a focus on really providing a scalable solution that's replicable, high quality, controls TCO, and puts out some of the key indicators and management levers that people want to use to really run their organization and keep compliant. Underneath that, you'll see three verticals that will tend to be areas of information that will feed in to the reporting and analytics capability. They're differentiated types of information in terms of the analytical outputs that are required or the type of information, and that's why we've kind of used them as almost supporting things for the reporting, analytics, and control layer itself. Lower left-hand side, you see what we call IT and process operational risk and compliance. That will tend to focus on qualitative information, the types of things that you would require for SOX, certain Dodd-Frank type of qualitative information, IT GRC requirements, and the like. In the middle, you see what we call integrated risk measurement and real-time monitoring, which will tend to cover credit, market, liquidity types of risk requirements. We're talking about large volumes of transactions, low latency, high throughput, a lot of stress testing, scenario analysis, major mathematical requirements, so pretty heavy-duty infrastructure support as well as application performance and middleware requirements there. And then finally, on the right-hand side, financial crime and surveillance, which we view as being a combination of different types of information, some quantitative, some qualitative elements, and so you need kind of a bit mixed model capability technologically to deal with that. That will include areas for KYC, CIP in the United States, anti-money laundering transaction monitoring, wide area surveillance types of capabilities, and also fraud detection, analysis, and monitoring, and then the related enhanced and customer due diligence processes around those. Going on to describe a bit further the reporting, analytics, and control layer that is the main focus for today. You have here on the left-hand side a description of the objectives, the kind of service offerings that we have, which covers implementing various types of COTS reporting packages and analytics products. A number of the vendors that we work with are registered and hopefully participating as listeners on today's discussion. What we call then, secondly, reg reporting services, which are the types of operational services to be covered by the reporting factory discussion today. And then thirdly, data management process standards and architecture design that focuses on improving data granularity, accuracy, and consistency. On the right-hand side, you see a couple of figures that describe in the upper right-hand corner both a disciplined approach that we use for COTS package implementation for reg reporting purposes. This is an approach that we've developed over multiple implementations, and one of the key benefits that we found, especially in implementing a certain type of COTS package we work with regularly, is that using this designs the data requirements up front quite crisply, making subsequent rollouts and reuse of the same platform much less costly and much more timely, much quicker time to market for subsequent country or regional rollouts. And so this is kind of an example of a methodology we've developed we use regularly. Lower right-hand corner, you see an example of what's covered in the Reg Reporting Factory service catalog that we're going to be discussing in a bit more detail. You'll see a larger version of this later on in the discussion. The next slide, slide 5 at the bottom, lists a number of our key case studies and proof points where we've done regulatory reporting work. Most of this is COTS package implementation, but a couple of the examples do cover the type of BPO managed reporting service that we're talking about today. The majority of them focus on Basel II, Basel III types of requirements. At the top, as you see, we probably are working with 4 to 5 different banks presently on either already in production Basel III reporting requirements or related type of COREP, FINREP, CCAR, Dodd-Frank Act stress testing types of requirements. So I won't go through each one of these. There is one example about 2/3 of the way down where we work running IT GRC relating to the IT and process risk and compliance offering I described earlier for one of the largest stock exchanges in Asia, and we actually do that as a fully managed service for them, not just having put in the COTS platform that enables that and supports that, but actually running the real-time monitoring capabilities for them, one of HCL's key horizontal capabilities is in remote infrastructure management, and that's one of the key areas that supports that capability for that client. Moving on now to today's discussion, focused on the regulatory reporting factory types of requirements we were talking about. This slide number 6 lists a specific client's target that they wanted to achieve, and they are the main use case we'll focus on for today's discussion. Global Universal Bank that made a key strategic decision to outsource a very large portion of their actual financial reporting operations to us. They have quite a diversified geographic footprint. They have multiple global business lines historically quite a fragmented reporting applications architecture, as well as very fragmented processes. Things previously were handled very much on a pure country-by-country and line-of-business by line-of-business basis, which is pretty much reflected in the current state left-hand side, not run in an extremely consolidated fashion. What they wanted to do was achieve, along the way, a major transformation in terms of reducing total cost of ownership by 30% by year 3 of the program, improving process flow as described in the middle column there, second box down across from scalability and capability on the left-hand side. Improve definition of SLA's KPIs, apply those more rigorously and consistently across the entire reporting population, and standardize data management, especially for traceability purposes, increasingly important in the regulatory reporting requirements. The overall end state on the right-hand side is reduction after year 5 of up to 40% overall in TCO. Increasingly automate processes and systems across various types of reporting needs, and then also focus on having quite a robust internal control framework dealing with many of the regulatory requirements you'll see at the bottom and standing up to both their internal audit as well as external regulator scrutiny. Slide 7 then describes a bit about our approach to this type of a customer challenge. It is something that we call EFAS, which stands for Enterprise Function as a Service offering. And we work now with a number of different clients using this type of an approach. I'm actually in the U.S. right now. I'm from the United States originally, but I'm based for HCL in London. But we're working now here with a large client that has a very major change program where we're looking to apply this again as well across a number of functions, in their instance, not solely for the finance regulatory reporting that we're talking about today, but for some areas that may be of relevance. The area that I'm focused on, for example, is what they call enterprise security services, which will cover that financial crime, KYC, CIP, anti-money laundering, monitoring, and fraud monitoring, detection, and analysis work. And one of the things they're looking to do, and they're speaking with us, is putting those types of operations as well as some more standard loan operations and investment operations into this type of a model that's described in the upper left-hand corner, of slide 7. What you see in those enterprise functions that we've listed, for example, as HR, sales and marketing, legal and compliance, logistics, supply chain, and finance, are the types of things that will tend to be not specific to a single line of business, but there will be common enterprise types of functions that are normally handled at a group or global level. And what we take on, as this model in the upper left-hand side describes, is the business processes, both custom as well as enterprise applications. So custom can include existing applications they have that they've coded themselves, can include COTS packages, which begins to enter into the enterprise application space. Enterprise applications would include ERP types of offerings from the likes of SAP, Oracle, and the like. Putting a common data management layer across it, as you see towards the bottom of that diagram on the upper left-hand side, and then providing the infrastructure services, as I cited as an example earlier. For the finance function, you'll see in the upper right-hand corner, kind of midway, to the left of what's called Extended Enterprise IT Organization. The 5 key areas that for this client use case I'm talking about, we're covering. And so you can see it's not restricted solely to reg reporting in this instance. It covers regulatory reporting, but it also includes subledger and general ledger postings, account payable, account receivable operations, cost and expense accounting, and then conventional performance reporting, performance management. And through putting it in this type of a common operating model, with most clients, we're usually able to deliver a minimum of 20 to 25% reduction in business operating cost over a 2 to 3 year period, at least to start. Moving on to slide number 8, this describes in a little bit more detail exactly what we're doing for them. The ask is pretty much as I described before: take over in-scope work on a business process outsourcing basis. That's the key focus for year 1, which we're getting about 2/3 of the way through at this point in the program. Starting from year 2, we are beginning to transform the underlying IT systems, largely some of the business applications, increasing standard application of them across various parts of the operation and reducing use of end-user desktop applications in particular, and create an overall shared service organization that covers both IT and BPO areas. In the upper right-hand side, you see some of the scope of the work that we took on. As I noted, covers both BPO and IT, over 5,000 different types of reports. It covers all lines of business and geographies globally for this entity, with a rather substantial total contract value on a multi-year basis. The utility description at the bottom of page 8, where you see finance reporting, which is that performance reporting as I discussed earlier, local reg reporting, cost accounting, and then group reporting and planning, which is a consolidation function. You'll see there again, for each of those, what we're doing during the first 0 to 12 months, which is focused predominantly on pure lift and shift, business process outsourcing types of requirements, and something slightly more sophisticated, where there's centralization and offshoring. And then from year 2 is when we focus on IT operation, outsourcing, and then technology platform transformation as well. And you can see what the estimated total savings are after that is completed. Going on now to slide number 9. This talks about the process that we went through with this client when we actually analyzed what their requirements were. We started at the left-hand side with an existing model of essentially, you see 4 verticals that represent the demand pillars that I was describing between performance finance reporting, cost accounting, reg reporting, and group consolidation. And then the left-hand side, you see different types of services, top to bottom. And that will be described in more detail in a follow-on slide what those services are. We then looked at the existing headcount population to see, right, what kind of a grade mix do they have? Are they top-heavy in terms of management compared with what might be a more optimal kind of cost and operating allocation? And then we looked for, secondly, the pyramid below that on the left-hand side of slide 9, what's called operating synergies, which is where you look across the different vertical demand pillars and then the processes that they're using to provide the outputs and say, right, what's common, what's differentiated. The common type of things you begin to combine, consolidate into a utility, and you create economies of scale or operating synergies, as we call them there. That then provides the BPO transitioned model that's achieved by the end of the first year. The second year then goes into what's called process transformation, which also includes technology transformation. By then, we've reached what we call the optimal organization, the pyramid in the slight upper right-hand side of the slide. We look also at technology enablers, achieving best practice process levels, and you end up with a fully transformed state on the right-hand side that includes the technology transformation that I was describing as well. On to slide 10, you will see an enlarged version broken down in more detail of what was the diagram in the middle of the prior slide 9, and you see at the left-hand side the discrete types of service offerings that we make available, and they are grouped further into kind of groupings covered in red. Governance, data management, and financial close process is how we've described those. And you can see how they're allocated. So the stakeholder interaction process, both internal stakeholders, external regulators for reg reporting, that would also include, shareholders and what have you. That will remain, generally speaking, the responsibility of the client. That's the type of thing that they do have to remain responsible for in the eyes of the regulators and a number of other stakeholders. Then once you come away from who they're serving, but how they control things through creating governance policies and a quality oversight structure, we begin to share responsibilities with them increasingly, and there begins to be overlap. And then HCL in this EFAS model, we predominantly take over the control, which is operational process control level, data management, report production, and most of the transaction and close processes as well. And you see then across the top scattered the overall scope that's covered, hundreds to thousands of different report types, different enterprise functions, and different lines of business, which is the example that's been used in this client situation. As I go on to the next slide, you'll see again a more granular, drilled down version of this that describes more discreetly the full service catalog that is offered across this factory model, and also will show a lot of the rationale for why it's a good way to reduce TCO, control quality, centralize processes, create economies of scale. That'll be a slide or two down the way. Slide 11, which we're on now, shows a case study not for the main client that we're describing today, but for a client that we brought on earlier in the process. We've been working with this client for probably 3.5 years now, and took over initially a platform of theirs that was reporting for Basel II purposes specifically. We've now, in addition to actually running that platform for them for a number of years, with a small number of people in single digits, but producing for them all of the regulatory reports they require for 14 different legal entities across 9 countries in the EMIR region. We've also migrated them off of the older Basel II platform onto a new Basel III platform as well, and have that in an operating mode where we're pumping out the reports as well. So you will see kind of left to right your conventional source to target architectural and operating model, where you have multiple different source systems left-hand side. You have different staging areas and transformation areas that go through. You will see at the bottom the types of activities that relate to each key staging area, and then you will see on the right-hand side the output of COREP and FINREP compliant reports and how those are handled. And we, for this specific client, reduced by approximately 25% over the first 18 months the actual cost of ownership of this function. And now that we've gone to a new version of the platform for Basel III, the total cost of ownership is continuing to reduce further as it's a more effective platform technologically as well. Slide 12 outlines essentially from a kind of a waterfall perspective at the bottom how the benefits are achieved by implementing this model. At the top, you will see how your business starts out with, again, on the vertical axis, you've got financial reporting, reg reporting, cost accounting, and group reporting in that group of cubes at the left. And then at the top, you see each of those are replicated across, for example, different lines of business, like banking operations, insurance operations, which might exist, asset management organizations, and possibly you might have a separate card issuing affiliate as well. And then as you begin to transform, you create more of a shared service where those are not totally separate cubes, but the financial reporting, reg reporting, cost accounting, and group reporting functions are run in a common basis irrespective of the line of business or geographic differences. And you see the kind of benefits that are realized upper right-hand corner. Again, at the bottom, this is a waterfall diagram that shows the benefits, first of all, from BPO efficiency, kind of through the middle of the bottom area, and then IT transformation-related benefits. And so you can see very significant total cost reduction throughout the entire process itself. Slide 13 now is the more granular version of that diagram that we showed earlier, where you had groupings of the different service lines, where I talked about stakeholder interaction, governance and quality assurance, controls, data management, report production, and we have combined in this, we don't show the close separately. That was simplified out just for purposes of this discussion. But what you have here is a granular description for each of the 4 vertical demand pillars: cost accounting, reg reporting, performance reporting, group reporting that you have across the top. You see in red what are common types of activities and actual services in our service catalog that are required for each of those 4 demand pillars. And the ones that are in red are ones that are required commonly, irrespective of whether the demand is for cost, or group reporting, or reg reporting, or for performance reporting. That's the thing that begins to make this something that leads to TCO benefits, platform standardization benefits, overall economy of scale creation, eases traceability for reg disclosure purposes, and the like. So what we tend to do, interestingly, this model, we have a couple clients that have taken down this model using all of those services that are on this area, but we've had discussions with other clients that feel that their close process, for example, has a lot of existing integrity, or they don't want us to become involved at all in any of the stakeholder interaction or even some of the governance and quality assurance areas, but they feel that their data management activities are not really up to scratch, and that's where they will ask us to focus on data management and the report production, the 2 types of service classes horizontally across the bottom of this model. So one of the things that's interesting is this model is a very good framework for having discussions with clients, and allows them to chunk out the type of work that they either want to commence with or that they want to provide to a third party partner like ourselves, but then also allows them to understand quite discreetly what they want to keep control of themselves. And so it defines what we call the interaction model, which will be displayed on one of the later slides, quite discreetly in terms of which services are performed by which of the participants, whether it's the client or whether it's us or even some other third parties that might be working with, who's responsible for which handoffs, and then you go through defining what are the KPIs, SLAs, controls relating to each handoff situation. Slide 14 is an example of this type of the so-called interaction model that I described. You will see again at the left-hand side the types of high-level service classes that I discussed. You will see addressed by each of the numbers in the red circles, basically a flow noting a specific request in this use case for a new or updated report type coming in. That's in the red circle number 1. That will come in from the outside. The reason that that's red in this model connotes something that the client is responsible for doing and bringing in. They then set in step number 2, the high-level business requirements. Step number 3, HCL begins to become more involved. The client will help set the policy standards overall they want to achieve. We begin to define what are the operational procedures that are required to deliver that new report or updated report type, and we define some of the process audit requirements. We then go through in step number 4, the actual report build and testing, as well as the report and maintenance. Step number 5, going down further towards the bottom of slide number 14, We implement a very standardized, robust, cross-functional data governance, data quality control process that then leads to step number 6, standards and quality control as well as extraction from source systems. A lot of that will be coming out of the actual financial close process itself, and will include the appropriate data security controls and the like. That's something that obviously is a key trusted partner with substantial offshoring requirements is of key concern, especially for reg reporting purposes, and we have a lot of clients spend a lot of time working with us on that. We have very strong capabilities in that going back a number of years. As you then begin to finish the actual reports themselves and you go on to step number 8 in this interaction models, we call it, you have the actual data sourcing, calculations, transformations, aggregations that take place. Step number 9, going back up again, right-hand side of slide number 14, you have the actual report production validation processes that take place. Steps number 10, there's 2 of them here on this diagram, focuses on legal entity financial review, transaction level testing, analyzing the results, and then report finalization, and then that leads up to step number 11, where the client themselves actually does the regulatory submission, but we've done all of the actual content, assembly, compilation, finalization, and provision to them. And that includes, in most instances, actually rendering them into the local language requirements as well. Slide number 15 then begins to get discrete about where we are taking this for the U.S. market in particular. This outlines some IP that we have created specifically to support the comprehensive capital adequacy requirements in the United States. It's a table that lists the facts and dimensions required for different types of CCAR reports, the report types being listed in the vertical column at the left-hand side, the vertical axis. The horizontal axis across the top lists the actual data elements, fact types, and dimension types themselves. And so this begins to show clients which facts and dimensions are reused most frequently, lending themselves to this type of a factory approach that I was discussing for producing reports required for CCAR, and then also some of the Dodd-Frank Act stress testing reports as well. Slide number 16 then shows, relating to how we've used that matrix that was described in the prior slide, a number of the reports that are required, and they're available through us now, specifically to deal with the Fed Reserve Y14A requirements, which are focused on counterparty credit risk and capital adequacy requirements overall. You'll see across the top 3 report types, which really talk predominantly about how you identify through these reports your top 200 counterparty credit value added adjustment amounts. You then stress them, the middle report at the top. You then look at the net CVA when you take out collateralization or other types of netting requirements as well. Then going down to the middle row of reports, you have your gross counterparty CVA exposure. You aggregate it across different clients as a function of risk rating. You have expected exposure profile by counterparty, expected exposure profile by rating, the lower left-hand side of this slide, credit quality by counterparty, credit quality by rating. So those are a list of reports that we have that deal specifically with counterparty credit risk capital adequacy. And we've also done, on to slide number 17, reports required specifically for Basel III and Dodd-Frank Act as well, both on an annualized as well as, you can see, a quarterly basis among the 6 report types that are down at the bottom of this. You have in the upper left-hand corner capital composition, which deals with really, how your capital breaks down as a function of paid-in capital, retained earnings, reserves, what have you. You have an exception bucket calculator, risk-weighted asset, advanced categories, general categories, levered exposure, planned actions. Second row, rightmost diagram is really your planned capital actions, really around dividend policies, using distributions for other purposes as well. And then again at the bottom, as I described, you have your the quarterly versions of a lot of the reports that are shown on slide 17 in the upper portion of this that will be more annualized reports. And so what we're looking to do, the reporting factory itself that we have, that we operate, historically has focused mainly on reports required for European regulatory requirements, FINREP, COREP, Basel III, what have you. Covers also a lot of the similar types of requirements for Asian countries as well as African countries, and we're increasingly beginning then to modify and expand the range of what is covered by the reporting factory concept to deal with the new legislation in the United States focused on CCAR and DFAST types of requirements, and we have these types of reports in slides 16 and 17 available out of the box to use in that type of a factory model going forward. So with that, the fixed portion of the presentation is completed, and I think Neil and some of your colleagues were available for questions now.
Indeed, and thank you to David for a fascinating presentation there, and indeed for a mention of that old bugbear Sarbanes-Oxley, which is perhaps yet another driver towards regulatory reporting factories, alongside the modern kind of stress testing and Basel III capital adequacy requirements. So now let's move on to our Q&A session. I can see that we have several questions already, but just a reminder, if you do have a question, please type it into the box on your console and I will read it out. So we're trying to get through all the questions today, but if we run out of time, we will get back to you offline. So without further ado, let's move on to the first question, David. And it is basically just asking what's the single biggest regulatory obligation for CFOs or for risk and reporting officers in the US at the moment? So perhaps that's CCAR, perhaps that's Dodd-Frank. What do you think, David?
Yeah, I mean, I think it's a combination thereof. The majority of clients that we have are very focused on the CCAR types of requirements for what I would call balance sheet banking organizations. Some of the more flow-focused businesses will obviously have, transaction-level reporting requirements historically for derivatives and other types of structured transactions under Dodd-Frank Act, and then increasingly also the overall capital adequacy stress testing requirements that Dodd-Frank brings in as well. One other class of regulations that we're finding increasing focus on by clients who are not headquartered in the United States but which have very significant operations there is the foreign-based banks are beginning to be captured by the same kind of regulations encompassed in CCAR and DFAST that have historically applied to U.S.-based banks. So the foreign bank holding company legislation that's coming into effect largely from, I believe, the end of 2014, beginning of 2015. There's a tremendous demand for services relating to that, where the playing field is really being leveled and made common between U.S. headquartered and non-U.S. headquartered organizations, where the ones that are not headquartered in the U.S. now will have to create a formal legal bank holding company based in the States, discreetly attribute and keep and report capital just for the U.S. operations only, and have that available to support just those operations in the case of a need to liquidate, modify, or resell or run down those businesses. So essentially those three would be the key areas, the CCAR proper, Dodd-Frank, and then this new foreign bank holding company legislation is where we see the majority of requirements at present, certainly from the finance side of the house anyway. Yeah.
Thank you. That's really interesting because it perhaps plays into the FATCA regulation, which is covering kind of tax obligations and has a supranational kind of element to it as well outside of the US borders. So So that's interesting that you're getting that kind of global reach now. Just moving on to the next question I can see up here. It's actually really essentially the same question but for Europe. So they're asking, what is the single biggest obligation for CFOs, for risk and reporting officers in Europe? So whether that's EMIR or perhaps CCAR, what do you think it is in Europe, David?
Yeah, I mean, this is probably phrased, well, I guess it is phrased the same in that it's facing CFOs and risk and reporting officers specifically. I've mentioned COREP and FINREP. COREP is essentially the equivalent of the capital adequacy regulations, CCAR. FINREP is very much reporting, focused on financial reporting, standardization, accrual, counting related. And the purpose of both those, and this is very important to cite and really helps to reinforce the use of a reporting factory. Both of those standards are focused on enabling the regulator to have full traceability and analytical capabilities for either the COREP, the capital adequacy and balance sheet risk aspects, or the financial reporting under FINREP. And so the XBRL standard, which has been used in the United States by the SEC for listed company reporting requirements historically, but not necessarily applied universally to the financial services sector per se, is the linchpin for Europe, and is really setting the standard there, and then certain APAC countries have started implementing it as well. We see a tremendous demand for COREP implementation, FINREP implementation, EMIR, as you've noted, and COREP and FINREP will kind of be captured as portions of EMIR. You have a certain amount of transaction level reporting that will be the European equivalent of Dodd-Frank, but was also started kind of under the MiFID guidelines a number of years ago. But then XBRL is really becoming the game changer as well. And most clients that think carefully about this will usually, when they're dealing with COREP and FINREP compliance, begin to bind in XBRL-related capabilities as part and parcel of that.
Right. That's interesting because, of course, the stress testing regime that you mentioned for America as well is also on this side of the Atlantic via the ECB. So, I mean, there is perhaps some duplication there globally, and indeed that was the next question about, frankly, the welter of global regulations, just to include Asian companies here. I mean, do you think that's one of the big challenges with Basel III that's been mentioned earlier, just the sheer global welter of regulations, and perhaps you need a factory to handle them?
Yeah, that's actually, we've kind of found that. In creating this factory, not necessarily the first factory with the client, which was the one where I noted that we've been running it for a number of years, but the one that was created more recently within the last year, we actually worked with the client because of their overall global scale and exactly the very large geographic diaspora that it covered. We worked with one of the big four accounting and consulting advisory firms who really has helped significantly bridge the gap between us as an IT and BPO services provider and the client as a regulated financial institution, and that big four provider, they're an entity, some of whom today's participants are representatives of that organization, or at least the registrants. They helped identify some of the key regulatory requirements that needed to be met in certain geographies, and then especially for that operational control and then the QA types of services area are helping to suggest the appropriate SLAs, handoffs, KPIs that both we and the client should be responsible for. The Big Four entity is not involved in the actual operation of the utility itself, but they're really kind of in a mutual advisory intermediary role as part of this transaction. And both sides have found them extremely useful in that role, especially to deal with this type of issue that this question focuses upon.
Okay, that's interesting. I noticed we've had a question coming in about jurisdictions, but I think we'll come back to that later as part of the global conversation, because there's a question that I'd like to ask first, which has come in just really a back to basics question, and somebody wants to know how a regulatory reporting factory can help. So in practical terms, you know, what does it do? How does it work? I mean, can it automate OFAC sanctions, for instance, screening alerts and SARs, and deal with that financial crime area that you mentioned?
Yeah, that's a very interesting question, because that's essentially the client that I'm working with here in the U.S. Midwest at present, right, where we're actually going through a process with them, a key toll gate tomorrow, where they've asked us to look at this exactly. They have asked us to look at taking over a population of about 250 people, specifically in their financial crime area, and us taking over the actual operating processes as well as the IT platforms and running them in exactly this type of an enterprise function as a service model. OFAC, SARs, CTRs, those types of things are part and parcel of what they've asked us to look at. And so the answer is yes, we think it can be accomplished by this type of a model. Certainly we've already operated it for financial regulatory reporting purposes for a number of years, as I cited. We've done also in a factory basis certainly KYC and CIP operations, especially portfolio reviews, for a number of years. Gosh, when I was a client of HCL, I actually ran for one of the very large global universal banking organizations. Their global KYC client and product data operations and technology processes. So that includes responsibility for global KYC compliance, all of Europe, all of US, all of Asia, okay, right, probably about 30 different jurisdictions. And one of the things that I very quickly actually put into this kind of a factory model, and I'm very glad I did, was reviews of the major KYC portfolio segments, starting with the UK, then went on to the United States, then went on to the continent. And we ran through the factory equivalent that we had at the time for KYC updates, re-reviews. I believe we did about 250,000 accounts under about 18,000 different legal entity counterparty profiles in the space of about 10 months, as I recall, where it was very much run as a risk-related, risk-stratified type of factory, where things that were deemed initially lower risk were largely automated feed handling-based techniques, and then we applied a risk-weighted audit exception model to looking at doing quality control. When there were new updates to certain types of data dimensions, those were accepted out and kind of run through a second-level checking process. And then the high-level, both jurisdictions as well as deemed high-risk clients, those were the things that were done more manually.
Interesting. Okay.
Yeah.
Well, I think maybe we'll come back to the jurisdiction question now, just because that's something that we're discussing at the moment.
Yeah.
Before we do, though, because you mentioned financial crime there, we've had a question come in from Deirdre Sullivan here, one of our listeners today, and she's interested to know about security and or issuer level data sources, and if they're currently interfaced and available. Is that something you'd like to comment on, or rather go into the jurisdiction?
Well, no, I can try. It's just there's probably some additional nuances to the question that I might ask about. If she's correct me if I'm wrong, it was issuer level?
Yes, correct. Yes.
Okay, fine. Yeah, issuer level data actually tends to be quite widely available. I mean, that's largely, if it's not public domain, it's fairly common reference data that will tend to be available, especially for anything that's publicly traded or publicly listed. So there needs to be a high degree of transparency to that, and you can get that and run that in an automated factory without a problem. I dealt with it not necessarily on just the issuer level, but certainly when you start talking about fund level types of data, it becomes quite a bit more complex without question. But that can be handled in this type of a fashion as well. The security element, that is a question, are you talking about physical security? Are you talking about, are you talking about user entitlement rights? Are you talking about view but not change? What types of security? There's a wide range of different security aspects that one needs to consider when you're going into a factory model type of approach. So maybe some further drill down on that, or if Deirdre would like to have an offline chat about that with me, I can go through that in a bit more detail. I think that the one thing that I do want to, again, citing from past experience, again, when I was a client of HCL's, and this is maybe why I think HCL is fairly capable of doing this type of a factory approach that I described. We had one specific instance, which was response to a compliance request from the New York State banking authorities at the time, where we had to go back and retrospectively calculate haircuts for transactions that we should have calculated haircuts for going back about 2 to 3 months or so. Right. And this was in a sales and trading environment. This dealt with low risk to medium risk fixed income securities, government, predominantly munis, and to a certain extent corporate issuers in the United States, where a very broad range of counterparties, trading counterparties, had been buying and selling these with our organization. And so there was a lot, unfortunately, of fund level, private fund level data that we had to work with to help calculate the haircuts. And we were able to do that through this type of a factory type of approach and concept. It is the only way we were able to do it to be able to comply with what the regulators asked us to do on a look-back basis at that point in time.
Interesting. Okay, thanks, David. I noticed we've actually had quite a few questions come in now on jurisdiction, so let's turn to that. We've got one here from Rohit, for instance, and he's asking about is it challenging for corporations that operate in multiple jurisdictions, and how do you deal with that, really?
Yeah. It varies quite a bit. I mean, there's certainly, in most of the audience, since you have a sophisticated, audience that listens to this, will be fairly familiar with. There's certain areas where, client data privacy is an extremely sensitive type of topic. You have a number of countries in Central. Pardon?
Sure. Particularly in Europe.
You have a number of countries in Central Europe. There are a few of the APAC jurisdictions that are very, very tight about this. Looking at client data from offshore, taking it offshore from Korea, for example, is a real challenge. And so a lot of people leave data physically solely in Korea. And if you need somebody offshore to look at it, the server has to remain in Korea, but you can actually assign entitlement rights to a factory group that might be based in Singapore, for example. We're familiar with clients that have done that in the past to deal with that. So it is certainly something that one needs to be very sensitive to, aware of, and there will be some places where some jurisdictions, a factory model might not be able to fit and address the local requirements. And so, for example, in this main example that I described today, there are certain geographies, I would think probably out of 50 or 60 countries that we're dealing with in the main, there are probably 8 to 10 of those where there's a fair portion of the, quote, factory population or the client retained population that is not offshored or outsourced, and those are kept onshore for client data confidentiality or other data security or privacy reasons to deal with the jurisdiction. But probably 80 to 85% of the total report requirements and reporting population has been successfully offshored.
Okay, that's interesting. So
so it's differentiated by jurisdiction, sometimes by business line, certainly as a function of the type of client counterparties as well, because obviously the sensitivity around individual private clients in a retail bank is very different compared with clients that might be, licensed financial institutions. They're publicly known. They have common reference data and the like.
Yes, and that's interesting because it presumably plays into the kind of not just the regulatory angle, but clients will perhaps have their own particular SLAs or demands as well, and you will need to flex the factory to fit those demands, presumably. Precisely.
So these are not by any means one size fits all. I think what is relatively common is you do look at the types of data dimensions and facts using a fairly common framework, for example, that matrix that I described for CCAR type of reporting, but then how the clients themselves want to parameterize what they are willing to share and put offshore versus what they want to keep onshore, and maybe either within their own retained organization or we will put an onshore organization. For example, this client that I'm working with here now in the United States, what we have proposed as part of working with them is that we would likely take over in toto their entire existing population in the United States in these functions, probably consolidated into a single geographical center, at least to start. And what would happen as a result is that would become a major onshore within the United States kind of beachhead and bastion for us, and would probably deal with, especially for CCAR and some of the DFAST reporting, for some of the Tier 2, Tier 3, and other smaller banks in the United States. A lot of those might be more sensitive about offshoring that, but they'd be much more comfortable putting it someplace within the United States. So that might well become a basis of operations for this type of an organization we'd be acquiring.
Yeah, that's interesting. Okay, that particularly plays into the kind of financial crime discussion we were having earlier.
Exactly.
Are really live issues at the moment. So. Okay, well, I'm conscious we've only got a couple of minutes left, so let's see if we can just squeeze in a couple of other questions before we finish. And there's really quite an open-ended question here, but I'd be interested to get your opinion, David. It's really just about if you think FIs and other firms are geared up to meet this raft of regulatory challenge that we've discussed in terms of their staff numbers and the available kind of compliance and tech support. It's, as I said, quite an open-ended question, but what do you think?
Yeah, I'm sorry. I was looking through some of the questions. If they're really geared up for it, I don't think, to be honest, most of them
they need that outside assistance.
Yeah, no, I think they do. I think that's actually one of the attractions of having an external factory capability of this type. Is you know, especially for a lot of the mid-sized Tier 2 to smaller-sized Tier 3 banks in the United States, and the way that the CCAR and DFAST regulation is going in the U.S. in particular, you know, they basically went after the top 15 banks by balance sheet size in the first wave of CCAR regulation. I think it was 2011-12. Second wave, which is the bigger Tier 2s, as we would call them, are really going on as we speak or have started in the last 6 months. And these are all just initial compliance efforts that tend to be put together in a relatively tactical solution fashion. But what we're finding is when you begin to put industrial strength, scalability, capability, quality control, including the Big Four, put them on industry scale platforms, you know, that provides an additional capability to a lot of different organizations to comply with this that otherwise they'd have to really ramp up their technology budgets, really ramp up their compliance function demonstrably, probably more quickly than they could do off their own backs, and then would be really economically supportable by them for their business as it is. This actually allows them to comply in a much faster and probably more cost-effective fashion than if they did it just on their own. So I think that might address the question more or less as I understood it.
Yeah, okay, no, that certainly does. I mean, it's similar to another question I have here, which has come in just asking about the availability of budget for innovation at the moment, because compliance technology is eating up so much of it, and whether it's easier to go with this kind of OPEX kind of route or not, perhaps using the cloud, perhaps using partners. So we can kind of...
Yeah, I mean, that's exactly it. One of the key focuses of this is to reduce the cost of your kind of OPEX, run the bank, reg reporting operations, leaving more for the discretionary innovation types of investment, rather than eating up your kind of change the bank budget when you do it all off your own back.
I see.
Yeah, so that's a very good question, and that's an additional benefit that this type of an approach offers, because increasingly people are saying, right, why should we spend such a large proportion on keeping things ticking over and leaving very little to almost nothing for innovation, new types of client engagement requirements, what have you, non-regulatory requirements. And this actually helps address that key strategic challenge for most CIOs.
I see. Excellent. Okay, well, I'm conscious, unfortunately, we're running out of time. So we did have a question in from Rehan in Singapore, but unless you're desperate to answer that, I think we might connect you guys offline if that's
yeah,
okay,
that's fine.
David. Just because we are running out of time, and I like to give people an opportunity to stress or add anything at this point. So if you'd like to do so, David, then please feel free to go ahead. Certainly, from my point of view, I think we've had a fascinating discussion now with some case study examples and particularly the financial crime area, which seems to be quite prevalent. So it's interesting to see what kind of uptake you're going to get for this approach, and it sounds like you're getting traction already. So,
good, yeah. Well, thanks. First of all, again, I just wanted to thank the people that tuned in today for this. Really appreciate your attention and interest. And certainly if you have further questions at the end of the presentation right there, that last slide, you got my email address, david.paris@hcl.com. So feel free to fill my email inbox with questions directly or through the folks at bobsguide. And again, thank you for your interest and participation today, and look forward to engaging with you and the folks at bobsguide further down the road on this and other topics.
Okay, well that's great. I mean, as I say, unfortunately we are out of time now, so thank you to you, David, and it just kind of leaves me to remind everyone that the recording will be available on bobsguide if you'd like to listen to this afterwards, and to thank you all for attending today, really, and we look forward to welcoming you to another bobsguide webinar in the near future. So thank you all, and goodbye.
Yeah, thank you. Bye-bye.